This is the Daily Market Rundown live from the Tradelo trading floor. It's August the 14th. Some highlights from today's show. Bitcoin hits a new record high. Russel rotation is set to continue. And the US PPI data is now in focus. Good day traders and welcome. It's Thursday and of course we've got quite a lot to talk about. Of course I think the key sort of takeaway from yesterday's session was the rotation trade. We spoke about that in the Daily Market Rundown yesterday. It was very much a sell technology and buy economy based type stocks, and of course that's what led the Russell in particular yesterday to a very strong 2% surge. It is up currently 5% this week, with the Nasdaq only up 1%. So that rotation trade is not just in full flow, but it's also expected to continue now as we move, of course, into Jackson Hole, which is later on towards the end of the month. Now let's get stuck in and talk about our first topic today, and it's very much topical. It's very much one of the final key risks for this week, and definitely going to present some weekend trade opportunities. And it's all got to do with the Trump-Putin meeting taking place in Alaska at, of course, 10:30 p.m. Moscow time tomorrow. Okay. Now, the key takeaway from all of this, and I'm going to kind of frame it before we go through some of the details, is that the market's thinking right now is that we are going to get some progress towards some form of a peace deal. Okay. What makes me believe that? Well, if we go look at the implied vol of oil in general, there's very little in the way of expectations of any kind of escalatory type sanctions. And we'll talk about some of those sanctions in a minute, because therein is the potential opportunity for us as traders. Okay, this is very much likely to be a non-event unless we get some secondary sanctions imposed, and we'll talk about what that can look like in a moment. But the key takeaway going into tomorrow is we did have Trump come out again with this severe consequences, telling us unless Putin actually puts something on the table of substance, there are severe consequences. He was asked, what do you mean, President, by severe consequences? Are you talking about tariffs or sanctions? Now that matters a great deal, because if it is sanctions, if it is secondary sanctions, and of course the type of sanctions matter a great deal, but sanctions are going to be a lot more impactful on the market, a lot more immediate on the market in terms of repricing of things. Okay, whereas if it's tariffs, we know that tariffs take quite some time to filter through into the general economy, and then it's also got to do with the specificity of the tariff. So tariffs not as impactful versus sanctions, but we will get to that in a moment. Now, some of the other key takeaways is that we're generally starting to get an idea. Of course, there's a poll going around that pretty much 70% of Ukrainians do agree to a ceasefire, not at all costs, but do agree to getting some form of a ceasefire. And the general thinking is, whilst Europe is pushing back on this idea of a land exchange, seemingly the murmurs are leaning towards this idea. Okay, it's more and more likely that there is going to be some form of a, we want this land, you get this land, we agree to a sort of a truce, and we stop shooting at each other. That's the general consensus of what is likely to take place over the course of the next 48 to sort of 72 hours. Now, one of the key takeaways with all of this, and I think this is again plays into this idea of, I'm going to call it the taco trade. It's not quite the taco trade, but it's similar in a sense that effectively what Trump has said is, I'm going to go into this first meeting, I'm looking for something of substance, but if I don't get it, okay, there are severe consequences, but he's added on this idea that there could be a second meeting. Okay, so long as the first meeting kind of goes okay, there'll be a second meeting, which means he's kind of keeping the door open to not just a one and done, but perhaps multiple meetings as we move our way on towards a deal. Now, why does this matter? Well, because look, if there's a second meeting, if it's announced there'll be a second meeting, it means things are going well. Things are positive at a very high level. The leaders agree that there is a pathway to a deal. And that's how you have to look at it. It's binary. If there's no second meeting, it means there are going to be severe consequences coming and the market will respond to that. If there is a second meeting, it means there is a door in which we are likely to reach some form of a peace deal. Okay, and that's how it goes now. It's very much, is there a second meeting? Is there not a second meeting? And the market will respond either way. Now, I spent a bit of time with our friend ChatGPT this morning just to bang out a couple of scenarios and in particular just look at particularly what sanctions are in place, ultimately what the impact of some of the sanctions could be and where the sort of the potential nuanced trades could come from. Now, obviously, we've got to go back to the start of the war. We know the US did impose some sanctions, okay? But I think what you need to take away from all of this is at a market level, the only real sanctions that were of any impact were pretty much the energy-related ones. Now, when I say of any real market impact, I mean for us as futures traders. Okay, sure, if you trade some single stocks in Europe and perhaps Russia, maybe you trade the currencies of Russia, or maybe you trade some of the products of Ukraine and Russia, fine. There were trades to be done there. But in terms of the futures markets and the most liquid futures markets, it was pretty much down to energy in terms of both nat gas and some of the metals as well as predominantly oil. Okay, that's where sort of the landscape of opportunity scope was for us as traders. Now, yes, there was some initial impact, of course, on the likes of DAX because of the ties between energy usage in Europe versus Russia. But ultimately, it all boiled down to energy. That's what you want to take away from it. So for now, I'm kind of going to exclude all of this. You can go and read that. It can be of interest to you. You can go and see what some of the previous sanctions that were put in place, which is the current US sanctions, and then looking at what the escalation options might sound like, might look like, okay? Because from there you can start to build out a hypothesis of where some of the trade opportunities can be. And this is kind of what the AI is talking about in terms of potential moves. Now, always with AI, I would take this with a degree of salt. Okay, don't forget this is AI just scraping from the internet. So again, use your brain. Don't see this as if there is a low price cap, oil is going to 100. It's not that simplified. Okay, the point is if there is a low price cap, if there are secondary sanctions put on countries like China and of course China and India, there will be implications for oil, and that's what we're going to discuss in a moment. Okay. Now, in terms of some of the scenarios, I think this starts to build out an idea of what we could get over the course of the weekend. But like I said, it boils down to, does Trump walk out of the first meeting and says consequences are coming, or is there a second meeting? I think that's the first sort of tradable opportunity. But in terms of probabilities, I think the biggest probability right now in terms of what the market's thinking is that there is a path to peace or a ceasefire framework. Okay, and therein you can straight away see, I think that probability is absolutely wrong. I think that's ridiculous. And again, this is just because of some of the shortcomings of AI. Okay, I'd say the path to peace, or at least the ceasefire framework, is the highest probably outcome. I'd say that's probably around 65 to 70%, just simply because of what we're seeing in terms of the implied volatility within the oil space. Okay, there's no real risk priced in right now. Now, sure, there is the potential that we see no path to peace and no framework. Okay, similar to what we had earlier this year. Of course, Trump was very annoyed, but this time, keep in mind, the two leaders are meeting. Okay, and the fact that the two leaders are meeting means some of the backdoor discussion have been fruitful. Okay, it means it's leaning on this idea that they're more likely to agree to a framework than not. Okay, so I'd say 65% we have some sort of a ceasefire framework, and again, how they get to that point, well, perhaps the US is going to create some financial incentives, relaxing some of the previous sanctions, whatever it might be. And in exchange, there'll be some land exchange. Most of those details are not so important, but in general, it will be positive for the markets. Okay, it won't be a negative for the markets. It will, of course, bring a little bit of oil supply back to the general marketplace. And again, that just depends on how quickly these sanctions are rolled out. Okay, it may be a case that more Russian oil supply could hit the markets, but not immediately, because first they need to work out the framework. But the general consensus is positive, path to peace, ceasefire framework is going to be good in terms of increasing supply of Russian product back onto the market. Okay. Again, good for equities. Generally speaking, not so good for oil. I wouldn't say there's much of an impact on this as gold dips, bonds dip. I don't think there's any real risk off safe haven going into this. So again, take it with a pinch of salt. I'm not so sure there's a sell bond, sell gold narrative in that. Okay. Then in terms of the next most likely one, I think is should we see some consequences imposed? I think again it's going to be perhaps more sort of targeted pressure tactics, and I think therein you could have something more leaning on this sort of line of things. And again, I think that's probably, call it a 25% or maybe even a 30% chance. okay, of secondary sanctions, or just trying to take the initial sanctions and reimpose them a little bit more stricter. And then finally, I think the least likely scenario, call it a 5 to 10% chance, is a major escalation. Okay, and therein I would say is the major opportunity for us, right? The one opportunity for us as day traders where we do get quite a significant escalation, the one opportunity scope where I think we get quite a repricing event where we suddenly see markets move aggressively, is a major escalation. Okay, so what might that look like? Let's talk a little bit about that and what we want to hear ultimately from the newswires that'll get us quite engaged. Now, I'm going to stress this. This is most likely going to be coming out over the course of the weekend. Okay, it's perhaps unlikely that we get any real sort of substantive information tomorrow, unfortunately. And so it may be a case of we only really start to get the news coming down once we head into the weekend already. Okay, and that means we do have some weekend plays to consider, and in particular we do have some Sunday gap opportunities to consider. Okay, now some of the escalation. Okay, I think the key thing to understand with regards to initial sanctions, the most important thing is, of course, we had a G7 price cap, G7, which excludes, of course, the likes of China and India, so they can still pretty much import the Russian oil. One of the bigger other sort of issues is, of course, a lot of oil goes to India and then obviously gets refined and sent back into Europe. So we know a lot of the initial sanctions, whilst they do create problems, of course, for Russian exports, they don't effectively stop the flow of oil from Russia. Okay, so the point was the sanctions were there more as an irritant as opposed to actually having a significant impact in terms of the flow of Russian oil. Okay, so some of the potential escalation moves, fine. We could have a lower price cap from 60 to 40. Does that have significant implications? Perhaps not. Okay, like I said, yes, there'll be perhaps a little bit of noise in terms of how oil moves, perhaps a little bit of a bit up in oil, a little bit of a risk off. But again, the implications of that are not that far-reaching, simply because Russia can send a lot of its oil outside of ultimately the G7. The real key one is ultimately this full secondary sanctions imposed on any buyers of Russian oil. Okay, and I think this is a potential threat. This is a real risk-off type move. This is a real opportunity for us as traders. Should Trump want to escalate, what he could effectively say is, fine, you want to buy Russian oil, China, you want to buy Russian oil, India, we are effectively going to impose sanctions on you, which means a lot of problems with regards to importing from the US, exporting to the US, using some of the US financial banking system. So it will create a significant risk of uncertainty for markets in the near term. Okay, even the threat of secondary sanctions being imposed on the likes of everyone will have far-reaching consequences. Okay, think $10 to $15 up in oil, think gold prices bid, think bonds bid, think equities offered. Okay, so that is a real sort of escalatory scenario. Again, very low probability, but we know with Trump everything is possible, everything is on the table, even if it's just a threat. Okay, and I think the threat will be enough to cause quite a near-term blip in the markets, and so that's where we focus our attention. Of course, there could be a shipping crackdown and some natural gas sort of extending, of course, some of the sanctions to natural gas. Again, that will have some implications for sure for European nat gas. Because they do still import quite a bit of natural gas from Russia. So that will mean effectively shutting off the supply of nat gas from Russia for the likes of Spain and France. And they will then, of course, have to go seaborne in terms of getting that nat gas in. So that will spike nat gas prices from Amsterdam. So there is a potential play there. But again, not a market that us as day traders are typically trading. So yeah, just keep an eye on that. If you do trade the US equivalent of nat gas, there should be a little bit of a bid up on that because, of course, Europe will then need to start stockpiling, of course, because we do have the winter coming up. So just a couple of scenarios to think about then. Nat gas is in play, oil is in play, and of course some of the base metals will be in play. And then again, if there is the key sort of secondary sanctions on everyone imposed, fine. That brings all futures markets into play, and that really will be some fun to trade at the Sunday open. Okay, now with that in mind, looking at some of the technicals, like I said, markets are not showing a great deal of concern. Okay, we can see oil is down again at the start of today's session. It is a slow drift low. We can see we're down almost 12% over the course of the month. So oil is effectively going into this with very little concern for these discussions. If anything, it's starting to price in this idea of more Russian oil hitting the market, 3 to 6 to 9 months from now. Okay, and that's kind of how to look at. We can, of course, see that backwardation has been unwinding since the start of the month, and that is that idea that more supply is coming, not just from OPEC, but of course now coming via the legal route from the likes of Russia, should we get some form of a ceasefire. Okay, so technically speaking, oil is offered. Technically speaking, there's not much risk being priced into oil, which means technically speaking, if we do have secondary sanctions imposed on the likes of India and China, okay, we could come in on Sunday and we could find ourselves all the way back up towards that 70, and of course perhaps testing the highs made back in June, July when we had the Iran-Israel attacks. But again, I think the Iran-Israel is a very good sort of place to look. You could see sort of these kinds of moves where we see a really significant, 10% move in oil in a very short space of time and a lot of volatility. Okay, I think that's what you will get as a result of secondary consequences. Okay. Now, of course, moving into today in terms of the risk markets, I think the indices are showing us exactly what to expect. And I think indices are a good way to look at it, but also I just wanted to show to you the rotation trade. There you can see, of course, week to date, NASDAQ, S&P, both up 1%, with, of course, Russell up 5%. Okay, that is the rotation trade. It's not likely to stop anytime soon. If equities are going to be bid, you want to be focusing on the Russell, focusing on the economy-focused stocks. Why? Well, because the markets are starting to like the idea of a 50 basis point rate cut coming in September. Now, with that in mind, rate markets are 100% certain a rate cut's coming in September, and we even starting to see some bets for a 50 basis point cut. Okay? Very normal behavior. Markets love to front run the idea. Of course, they will have to wait for Chairman Powell on Jackson Hole. I think it's the 22nd of August. So they will have to wait for him to come out and confirm whether or not that door is open or not. And of course, we will discuss that as we get closer to Jackson Hole. With that in mind, we can see, of course, this week that the DAX, the slight underperformer. Now, caveat, I think if we do get some form of a deal, some form of a peace negotiation, what you should find is perhaps Europe takes a little bit more lead next week. Don't forget, year to date, we can see it there roughly. DAX is up 22% versus the S&P up 8%. So don't be surprised to see that mantle being taken firmly a hold in the DAX next week. Don't forget, we're also a little bit off of record highs made earlier this year in the DAX, so there is still some upside to get to those record high territory. Okay, and then just in general, you can see the Mag 7, okay, really just mostly flat this week, despite the fact that, of course, we do have such positive sentiment. Okay, and we'll talk a little bit about that in a moment, because I think Bitcoin is pretty much a part of that sort of move away from tech into more speculative type stocks, but we'll get there in a minute. Now, the second topic for today is very much about the ECB, and I think this is an interesting article. You can go read it for yourself. The general thinking is that higher for longer. ECB's done. Rates are pretty much going to stay where they are for now, and we're now starting to talk about this idea of higher interest rates or a rate hike cycle starting towards the end of next year. Why? Well, because we're seeing a lot of fiscal spending, not just from the likes of Germany, but also, of course, the likes of France. So the big nations in Europe are spending big time. The thinking is that is going to create inflation towards the end of next year. Therefore, the ECB is going to be inclined to sit tight now, and there's no real need to cut interest rates anytime soon. And we can, of course, see that in some of the forward pricing. There is still a little bit of an interest rate cut baked in, and I think this is where the key opportunity is that right now, if we are going to see Europe, of course, not necessarily accelerate, but stabilize, the ECB is going to be quite comfortable sitting put. And should they not, or should they choose to sort of skip over an interest rate cut at the September meeting, I suspect the markets are going to push this idea of a rate cut even lower. Okay, in other words, at some point they're going to abandon this idea of more cuts, and I think that's ultimately just going to keep adding to the upside pressure in euro. Okay, don't forget, euro is the star performer in the G10 this year against the dollar. Why? Well, because there's fiscal spending in Europe. They're spending money. The general thinking is that's going to create growth. And of course, with interest rates where they are relative to the rest of the world, Europe is starting to look a little bit less like a basket case like it has been for the last 10 years. Now, with that in mind, we can see, technically speaking, this trade really much started back in March. It accelerated with, of course, Liberation Day. And that trend has not gone away. Okay, that trend is firmly intact. We can, of course, see now we are getting a few more pullbacks. We got a little bit of dollar squeeze there in July, but since then you can see we're up 3% this month. Okay, so Yes, very much pointing to the upside, very much 120s in reach at some point this year. Very much if we see all expectations of a cut start to be pushed up because of stronger eco data, don't be surprised to see us break above the yearly highs around that 118 and start to make our way towards 120. Point is, firmly trending to the upside. That's not going to change anytime soon, unless, of course, the Fed decides to come out and stay hawkish. With all bets now pointing towards 50 basis points being a chance. If the Fed is going to cut at every other meeting this year, that's only going to keep the euro bid to the upside. Okay, now in terms of today, we have got one data point, well, two. We've got the initial jobless as well, but the key data point's very much on the PPI. Now you ask yourself, well, why does PPI matter? Well, because don't forget, everyone wants to answer the million-dollar question, which is, are tariffs going to be inflationary at a consumer level or at a company level? Now, look, it's no doubt that the US is ultimately paying the price of higher tariffs. It's just a question of who's going to foot the bill. Is it going to be companies or is it going to be the consumer? Now, the general thinking is that right now of the tariffs, if you think of a tariff, 70% is going to be paid via ultimately companies or US consumers, and 30% will be absorbed by the exporter. Okay, that's the general thinking via Goldman Sachs. And now in terms of that 70%, we don't know who ultimately is absorbing it yet. Is it the consumer? Is it the company? If it's the company, ultimately we are going to see effectively headline revenues remain, but we will see a little bit of compression in terms of margin. So we'll start to hear about that perhaps in Q3, Q4 earnings. But ultimately, where we could get a little bit of a leading indicator as to how these costs are being passed on, or when ultimately it's going to start to hit the US economy, we could first start to see it in the PPI. In other words, if we suddenly see a big beat in the upside on the year-over-year PPIs or the month-over-month, what that starts to suggest is that initially the exporters took on perhaps some of the additional tariffs, or there was quite a lot of stockpiling, one or the other. But the reality is that stockpiling is done, and now exporters are starting to pass on those higher rates. Okay, and so should we see a bit of a spike in PPI, what the market's going to start to think is that initially companies are going to start taking it. They're going to start wearing it. Keep in mind, of course, PPI data is lagging. So initially companies are going to absorb the cost, but ultimately they're going to pass some degree of that on to the consumer. How much, we don't know, but we know they will pass on some of it. Okay, so PPI could potentially be a leading indicator for CPI in the months ahead. And that's why this data point matters today. And again, how we look at this, go and take a look at the month over months. Okay, we can see expectations today. That's the range of expectations with the min and the max. Again, should we see something like a 0.5 on the headline print for PPI month over month? That's going to spark a few concerns. Okay, that's going to create a little bit of concern of, well, hang on a sec. Maybe, just maybe, the Fed's going to have to be a little bit more hawkish, and there's no real pathway to a 50 basis point cut. Okay, keep an eye on this PPI, and I think the converse is very much true as well. Should we see a negative print today? Should we see a zero print on PPI? Again, that's going to be a real head scratch in terms of, well, hang on a sec. What is happening? Why aren't we seeing PPI tick up when we are seeing these higher tariffs? And ultimately, that will again also start to point towards, well, hang on a sec, we're not going to get too much tariff inflation pressure. We could actually see that 50 basis point becoming a reality. So both sides in play today. Zero print, negative print opens the door to 50 basis points. A high print, 0.5. We're going to see a little bit of pushback on those 50 basis point jumbo cuts. But ultimately, the market's not going to be removing rate cuts anytime soon. Okay, so the bar for rate cuts being pushed out is very, very high. That's how you have to approach this data. All right, Bitcoin makes record highs. Okay, it's back up there, back up record highs. We've moved quite nicely, quite aggressively, $10,000 since the start of the month to the upside. So almost a good 8% rally in Bitcoin, but it's not really been the performer. It's been all about Ethereum. We can, of course, see Ethereum up year to date, now 41%. And what a flip of fortune that has been. I mean, Ethereum was very much the lagging indicator until about a month ago. And of course, that has now flipped and turned on its head. For a number of reasons, there are some fundamentals, but also there is some speculative behavior coming back into markets. The key takeaway, I think, overnight is we really want to watch where Bitcoin closes today. Okay, right now, as of right now, this doesn't look too promising for Bitcoin. It does look like a very firm double top reversal, which doesn't necessarily point to anything bearish, but it does mean that perhaps the market is going to struggle up at these prices until we get some confidence to initiate above at record highs. Okay, so the close matters today. That's what I'm trying to lean on. If you get a mostly doji close today, so if we close somewhere around where we open, that'll be quite positive, and it will really open the door to a nice rally over the coming sessions, perhaps a little bit more upside towards 130,000 or somewhere there. But again, the close is going to matter. Weak close today is probably going to open the door to a little bit of profit taking. A doji close or a strong close above that record high opens the door to, of course, quite a nice rally in the coming sessions. Okay, and then of course, there you have it. It's all about the RTY. It's all about the Russell index. This is where we are paying attention. We don't want to be buying NASDAQ and S&P. We want to buy the Russell. And when do we want to buy it? Well, if you watched yesterday's session, you'll notice NASDAQ opened at the highs, tried to rally, failed, fizzled out, went small negative, and then started to rotate higher. Okay, what did the Russell do? Opened at the highs, made new highs, made new highs. When the NASDAQ pulled back, it kind of tried to pull the NASDAQ back. Oh, sorry, the Russell back, but eventually accelerated and closed up 2%. Okay, the point being is that you're not going to get deep pullbacks in the Russell, and that's why we want to play the Russell. Okay, it's not going to push you very far off sides in terms of downside, but it will give you that upside potential should the equities rally again today. That's why we buy strength, and ultimately we stay clear of the NASDAQ and the S&P. Okay, with that in mind, just a few things to observe about the Russell. Why are we focusing on the Russell? Well, if we go back to last year and we look at the slowdown that we had into August, okay, what we can see pretty much from sort of April, May, June, July last year in the Russells, that prices were largely unchanged. Okay, we then of course had a little bit of volatility in July and August when we started to see some really big misses in terms of some of the eco data, and that created quite a bit of volatility in the Russell, in the sense of initially we started to see rate cuts priced in the market, liked the idea of it. Then we got that really negative non-farms print in the market, thought, oh, we're into a recession already, and the Russell really panicked on that. But then, of course, Jackson Hole came along, Fed saved the day, opened the door to 50 basis point cuts, and that led to a really decent 11% rally into the US elections. Okay, and that's kind of what I'm leaning on. The fact that now we're starting to see this idea of more aggressive rate cuts at a time when the US economy is not that weak really does open the door to just a lot more upside in the Russell. Okay, I think at least another 5 to 10% in the Russell in the very near term, so long as, of course, we don't see that Fed turn hawkish, and of course we don't see a significant drop in the eco data. Okay, so it's very much a buy-only market in the Russell, and I do expect further upside as we head into towards the end of the month. Okay, with that in mind, there is a lot to digest there. I get that, a lot to think about. It's been a long daily rundown today. If you have any other questions, do post them in the Discord channel. Otherwise, as always, thank you and good luck out there. Manage that risk. Go make some money.